I have some good news. It appears that our investment thesis for real estate investment trust is now finally starting to play out, as REITs have risen by 8% on average over the past month alone. The market seems to be now slowly recognizing that it had overreacted to fears of higher for longer interest rates, not understanding that most REITs were not heavily impacted because they use little leverage and have very long debt maturities. Secondly, interest rates were hiked only because of the high inflation, which was very beneficial for REITs as it resulted in very rapid rent growth. And then third, the market appeared to have missed that this surge in interest rate was only a temporary solution to a temporary crisis. We hiked interest rates to fight off the high inflation, but now that inflation has cooled down, we're also likely to see interest rate come down significantly, and therefore it was an overreaction to reprice REITs at a decade-low valuations because of a temporary measure. But now the market is regaining its senses and REITs are on the way up. Inflation has cooled down significantly, and based on the comments of the Fed, it's quite likely that we'll see significant rate cuts in the near term. As of right now, the debt market is pricing 3 rate cuts still this year and another 5 rate cuts by the end of 2025 as the most likely outcome. What this means is that interest rates are now likely to come down 150 to 200 basis points by the end of next year, which is very significant because this is likely to completely flip the narrative about REITs. So far, they've been avoided because of fears of higher for longer interest rates, but now suddenly interest rates will come down. This will lead to REITs cash flows surging to higher levels, their growth will accelerate, and investors will not be able to earn enough yield from fixed income investments like treasuries and bonds. And so suddenly they will reallocate a lot of their capital back in the REIT sector. And I think that this could lead to an epic recovery. But what REITs have the most upside potential? And that's a question I've received from a lot of you over the past weeks. And I'm gonna focus on that on this video and also share some examples that I'm buying at the moment. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to talk to you about 3 categories of REITs that I'm buying at the moment. But before I get into it, I want to remind you that I just recently launched my REIT newsletter, High Yield Landlord, on Substack, and we are still offering a 2-week free trial as well as a $100 discount to our first 100 subscribers on the platform. So far, we're only on Seeking Alpha. We are the biggest REIT newsletter on the platform with over 2,000 members on board, over 500 5-star reviews, and now is your chance to be grandfathered in at a discounted rate and enjoy this 2-week free trial. You'll gain immediate access to all my holdings as well as my top picks for the second half of the year. I'll put a link to it in the description of this video. So the first category of REITs that are likely to enjoy significant upside in the near term are the highly leveraged REITs. And as I mentioned earlier, generally speaking, REITs are not using much leverage today. The average LTV is only about 35%. The debt maturity is also relatively long at 6 to 8 years for most REITs. But there are some exceptions. There are some REITs that were a bit greedy and took on a lot more leverage leading up to this recent rate hiking cycle. And as a result, they suffered a lot. They saw their share prices crash. Their cash flows also declined very significantly, especially if they were using some variable rate debts or had short debt maturities. But this also means that these REITs have a lot more to gain than your average REIT. A great example of this is Industrial Logistics Properties Trust, which saw its share price drop by something like 70-80% during this rate hiking cycle, but now it has already recovered nearly 50% just over the past weeks alone, as we got these increased indications that interest rates are likely going to lower levels. I'm personally not buying Industrial Logistics Properties Trust because I don't trust their management and they have some other issues, but there are some other similar REITs that offer significant upside potential and better risk-reward outcomes. Companies that come to my mind here are Farmland Partners. That's a farmland REIT in which we invest at High Yield Landlord. It's quite heavily leveraged. It has quite a lot of variable rate debt as well. At about 1/3 of its debt, it has a 50% LTV, and so it has suffered quite a bit during this rate hiking cycle. But now as interest rates are cut, its cash flow should recover very rapidly, and it should also help its market sentiment. So that's one REIT that we are looking at potentially buying more over the coming weeks. A second example that I've previously discussed on this channel is Unity Group. This is an infrastructure REIT that has quite a bit more leverage than your average REIT, and so it's more speculative. It's crashed very heavily over the past years, but this also means that it could enjoy quite a bit more upside in the recovery. I think that at the moment it's still priced at something like 1/3 of its net asset value. So if it doubled from here, it will still remain very heavily discounted relative to your average REIT. And there are many other such cases in the REIT market. Third one, Clipper Realty. This is one of the most heavily leveraged multifamily REIT. It specializes in apartment communities for the most part in the New York City City, so in Manhattan, in Brooklyn. Great assets, they are performing well, but the REIT has a lot of debt, and this is worrying the market. It has caused its share price to crash over the past few years, but now I expect a lot of upside in the recovery. Hey, sorry to interrupt you for a second, but if you think that this content is useful, could you please do me a huge favor and click the like button? That will help me a lot to keep on growing. Thanks so much in advance. Then a second category of REITs that I expect to enjoy a lot of upside in this recovery are what I call long duration REITs. These are REITs that own properties that are under long-term leases, and therefore they behave more like bonds, and it caused their market sentiment to suffer a lot as interest rates were hiked. Popular examples that you might be familiar with include Realty Income or NAREIT. These are what we call triple net lease REITs. They buy properties like Walgreens pharmacies, McDonald's fast food restaurants, and so on, and they then lease these on long-term basis with 10, 15, or even 20-year initial lease terms with several 5-year escalations. The rents are pre-agreed for the entire lease period. The tenant is responsible for all property expenses, and so these are highly consistent and predictable property investments that are quite similar to bonds. As a result, their market sentiment has suffered a lot, but they also have a lot to gain as now interest rates return to lower levels. But as I've discussed in previous videos, I think that there are better options than Realty Income in this peer group, and that doesn't mean that I'm bearish on Realty Income. On the contrary, I think that it's going to do quite well. It's likely going to enjoy some upside as interest rates are cut. However, I think that some of its close peers are even more attractive, and some companies that here come to my mind include EPRA Properties. So this is a net lease REIT that specializes in experiential properties. Its average lease term today is 13 or 14 years. It's offering a 7.5% dividend yield that's well covered and growing. The company's priced at just 9 times FFO compared to 13 or 14 times for Realty Income. So there's a pretty big discount there. And I think that as interest rates are now cut, a lot of fixed income investors will see the 7.5% dividend yield of EPR Properties and be very interesting in that, especially knowing that it's paid monthly, it's growing, it's sustainable with a relatively low 70% payout ratio. Another net lease REIT that could be quite interesting to look at the moment is called New Lake Capital Partners. This is a small cannabis net lease REIT. It specializes in cannabis cultivation facilities. Its average lease term is also about 15 years, and it's actually even cheaper than EPR Properties. It's priced today at a roughly 9% dividend yield. This yield is growing and also safe in my opinion. The REIT actually has no debt, and it has a big credit facility that could now use to acquire new properties at a large positive spread over its cost of capital. I expect them to make use of that in the second half of this year or in 2025. And so I'm quite bullish on this REIT as well, and I'm potentially looking at buying more of it. And then finally, the third category of REITs that I could enjoy a lot of upside in the recovery of this rate hiking cycle are the REITs that specialize in low cap rate property sectors. Good examples of properties that typically trade at relatively low cap rates are industrial properties and apartment communities. They trade at relatively low cap rates because these are more defensive assets with steady growth prospects, so there's a lot of investor demand for them. But I also saw some of the sharpest crashes in property values as interest rates were hiked because, you know, it's simple math. If your cap rate goes from 3% to 5%, your property value drops a lot more than if, let's say, your cap rate goes from 7 to 9%. And so because of this, these REITs saw their share prices crash very heavily. Good example would be Rexford Industrial Realty, ticker symbol REXR. It saw its share price drop by something like 60%, I think, at the bottom. Now it has recovered a bit, but it's still down about 40%, and that's despite growing its cash flow by 20 to 30% during the same time period. So its valuation is still about 2/3 lower than it was at its peak today. And I think that these industrial REITs as well as some apartment REITs will enjoy a lot of upsides as interest rates are now cut. This led to some cap rate compression, NAVs recover a bit, and the market sentiment for these REITs recover. So in this video, I mentioned Rexford Industrial Realty Trust, New Lake Capital Partners, EPR Properties, Clipper Realty, Farmland Partners, Unity Group. These are REITs that we own in our portfolio at Higher Landlord, but there are many more. And if you want to access our entire real money REIT portfolio, you can join our REIT newsletter for a 2-week free trial. There's a link in the description of this video. And if you're not ready to join our paid offer, we also have a lot of free research now available on Substack on some of our top picks. I'll put a link to it also in the description of this video. Thank you very much for your interest. If you could please click the like button, that will help me a lot to grow this channel. Subscribe also if you don't want to miss our future videos on other REIT investments. Thanks so much and see you at my next one. Bye-bye.